Welcome to TheoTrade. This is Don Kaufman. Here we are doing the weekend update on September 2nd, 2017. Into the holiday weekend we go. Well, first we're going to do a quick review of some of the action from last week, which can only be described as, well, one of the most wild reversals we've seen to the upside in quite some time. Let's get right to it here, starting with the S&P futures. What you're looking at, and again, I always like to kind of enunciate the time frame of the chart. This is a 30-day 1 hour on the S&P futures. And the reason I wanted to bring that up is to give you just a little scope of how wild some of the move happened to be this week on kind of an hour-by-hour basis. What you're looking at over here is the gap down, right in that neighborhood, a gap down inside of the S&P futures, which of course was the news from North Korea ultimately firing a missile. So we gap down. This is, kind of where we start the week. Monday starts off an incredibly slow day. We gap down on Monday evening, and then just literally it exploded to the upside in the S&P futures. Now, coming above the 2438 level, it has been nothing but upside into the last 2 hours of trade, where you can see we started to reverse back down. So again, nothing really new in that. What is, I think, incredibly important over here is when we start bringing you to the SPX, and I'm going to kind of zoom in on this. The SPX did, in fact, exceed the expected move. Now, for those of you that have been following some of the expected moves on a week-to-week basis, roughly speaking, okay, the expected move was about plus 23, okay, or minus 23. Clearly, we breached that expected move. And of course, I'll highlight that when we do breach those expected moves. Question is, by how much? Well, for the most part, we were expected to be closing in and around that 24.66. Okay, we actually closed out at 24.76. So it's about a $10 breach of the expected move. Again, on a statistical basis, it's significant because you start to look back at some of the breaches of expected move, like, all right, here's, $6, $7. We had a breach to the downside that was quite substantial. That was about $10, but again, a wild move to the upside in terms of the S&Ps. But it wasn't the S&Ps that really garnered most of our attention. It's the Nasdaq. And the Nasdaq in one of the largest moves we've seen kind of in recent times. And the Nasdaq's been Mr. Toad's wild ride. For us to say that this has been a large move is kind of an understatement. The Nasdaq actually breached the expected move by a full, clear 2 points. Now, that might not sound like a lot, but for the most part, we started out the week with the Nasdaq, and specifically I'm looking at the QQQ, at the 142 range. It ended the week smack on 146. Again, when you start looking at things, you look at the expected moves, you're like, all right, the expected move, for instance, is, $1.60, or the expected move is $2. Okay. Start putting things in terms of percentages, and you'll see how large this move happened to be. This is 1, 2, 3, 4 trading days. And again, I kind of give you a quick rundown. I just switched the chart over here to a year to date. Okay, and specifically now you're looking at a percentage chart. I prefer to make everything kind of statistically significant by looking at percentages. So here we are from kind of low to high. And again, behold how large that move really was. You're looking from 18% up to roughly where we closed here, which is 22%. Okay, these are phenomenal moves. You don't typically see index products moving, 3, 4, or even 5% within a given week, and much less ultimately off of a reversal where we exploded higher inside of 4 days, again, by over 4%. So next week, of course, we have a holiday week. Next week, the Qs are only looking for about a $1.60 expected move. So we're about to come into, again, a 4-day week where I don't want to sell premium. And that was actually one of the points that I made in last weekend's update. You want to sell premium when you're seeing moves like this that are just phenomenally large. Absolutely not. I'd rather be on the buy side of premium right now. And when I talk about, the idea of selling premium versus buying premium, I'm literally talking about like on a week-to-week basis. And again, I kind of like to enunciate that a little bit because people talk about, well, what does he really mean by selling premium, buying premium? And I'll get into the specifics of that. It's just a very straightforward idea. You know, would you want to go out right now and would you want to sell, for example, a straddle for 1 week? Now, granted, the market's only going to be open, okay, for the most part for 4 trading days, but nevertheless, you're only collecting about $1.50 for, this would be a naked short straddle. So you're only collecting $1.50 for that. I mean, how does that make you feel when you just saw, you know, a move from what? And now we'll switch back to of course, the numerical form here. So, you know, you can go out right now and sell that, you know, naked straddle for about $1.50. Would you want to do that after seeing a move from literally 141 up to 146? That's a $5 move that you just saw in 4 days. It doesn't look too appetizing, of course, then to want to sell naked premium for the next week. You know, 4 trading days for $1.50. No, thank you. Again, I would much rather be quite literally on the buy side of this. This has nothing to do with your directional bias. This has nothing to do with being bullish or bearish. Again, the expected move, it's so minimal in the coming week. And I'm going to reiterate that right now inside of the SPX. In the SPX, we've also seen a move. Again, this is from Tuesday to Friday. That's a move from 24.30, okay, all the way to 24.76. Again, when you start looking at this, you know, 40, 50 point moves inside of the SPX, yet if you take a look at the SPX options for 6 days, again, you're looking at moves that we all recognize were phenomenally large, right? How much premium is in here? There's nothing. Like the at-the-money options, again, all we're doing is just looking at the at-the-money options inside the SPX, okay? The at-the-money options are pricing less than $15 if you were to sell that. I mean, would you want to sell options for $15 when you just saw a move? And again, this is just, it's a great example of why sometimes I talk about, well, we should be on the buy side of premium or the sell side. Some traders just simply look at this and say, we must always sell premium. Really? Yeah, you see a 40, 50 point move in the SPX and you're going to tell me you want to sell something for $15 and then sweat for the next 4 or 5 days? It's nuts, okay? Again, even in the SPX, I'd rather be on the buy side of the premium. And if you're not comfortable with the SPX, fine, move to the spiders, okay? I mean, that's what trading's about. It's about finding the product that's, you know, comfortability for you. So, and again, the SPX specifically for the coming week, it's about, okay, and I'll just round it, about a $20 expected move. So again, if you're being forward looking, and I've already drawn on the screen the expected move, they're only expecting in 4 days about a $20 move. And again, I'd rather much be a buyer of that than a seller of that. So let's start to talk about some individual equity products. So again, we saw the markets, and I'm going to turn off these expected moves. We saw the markets explode. The SPX is just shy of an all-time high. But I started looking into this a little bit, and I'm like, what's driving the market? So we know that the Nasdaq, and again, I'll turn off these expected moves. We know the Nasdaq ultimately has its all-time high. It's in, it's there, okay? The Nasdaq pretty much closes in the all-time high. However, I will reiterate this again. If you looked at yesterday's trade, we did start to reverse very, very slightly into the close, okay? The Qs ended up down on the day. The Nasdaq futures were a bit down on the day, but neither here nor there. Okay. The thing that really bothered me about this last move to the upside, and again, I still maintain bearish positions, and I don't mind telling people that, you know, I'm bearish overall. It's because the leadership has really changed in this market. Again, we have 3 days that can be considered nothing less than spectacular to the upside. When I say there's been a change of leadership, you realize you have the S&P futures just, okay, a stone's throw off the all-time high, but the financials are still a bit lackluster in here, okay? So a quick comparison, again, and I've been using this on a percentage basis so you can get a feel. The XLF, which are the financials, are up about 5% year to date. quickly glance over at the spiders. The spiders are up 10% year to date. And you just have to ask yourself, the financials are a massive, massive sector. People, again, they have tendency to discount the financials a little bit, in accordance with, well, the financials are a lot smaller than, information technology. But if you look at IT, there are a lot of companies that move with the financials that are actually categorized into IT. So when you start looking at like all the technology companies, there are firms in there, okay, like some of your credit card companies and so forth, that I believe are kind of misrepresented because they get thrown in with the technology companies, but they move with the financials. Anyway, the financials are up 5%, okay? You've got technology, ultimately the Qs, up 22%. The S&Ps are ultimately caught right in the middle. And this is the shocking one to me, is again that the financials, they're still very, very much lackluster. And this is the sector that you've got to keep your eye on, because for the most part, and one of the reasons of my most recent kind of bearish, right, if you are into trends and so forth, this is still in a downward trend. The most recent, the most recent really, month chart over here, this is absolutely still in the midst of a bit of a downtrend over there. Now, I'm going to show you some other interesting areas. So we talked a little bit about the SPX breaching the expected move. The Qs have a statistical anomaly breaching the expected move. By the way, just to kind of, respect how wide of a margin this is, you're into almost 3 standard deviation territory with the move on the Qs. But let's actually look at some individual products, because as we said, the Qs, they're up right now about 22% year to date. Where's that leadership coming from, right? Look no further than Apple. So people look at Apple, it's, again, the largest market cap in the known universe, and they look at Apple, it really has taken, the markets higher, period, okay? Because you're not getting that action inside of Google. Sure, Google participated, okay, in that, wild 3-day rally over there. Nevertheless, if you look at Google, again, over the last couple of weeks, this thing, it got pummeled a little bit. Amazon is right there with Google. It got pummeled. It did participate in the 3-day rally. But when I start thinking to myself, you're like, why are you talking about Google? Why are you talking about Amazon? Again, sheer market cap. When you start looking at the Nasdaq futures and you realize they were at an all-time high, you have to start to question to yourself, what's driving them to the all-time high? Okay? Microsoft, it's right there. However, this is critically, critically important. Microsoft had a substantial, reversal. And this one, again, coming into next week, if there's something you're marking down over here, you want to look carefully at Microsoft, because it is in an incredible leadership role in markets right now. Microsoft breaks to an all-time high here at almost 75, has a wild reversal, and ends up down 1%. Okay? If anything, it led the markets to actually pulling back a bit. But again, Microsoft is the strength over there. Google, Amazon weak. Apple clearly is the absolute leader. Now, let's go back to Apple for just a second, because it's up 41% year to date. And to compare Apple, what else do we have on the screen over here? In terms of this kind of market cap, you're looking at something like Facebook. Facebook, again, big time leadership role over here, up about 47% year to date. Again, Google has fallen behind. Amazon, it's up almost 30% year to date, but has absolutely dropped substantially. And again, I'm just getting you a good percentage view of all of these, because there is one thing that's a little bit nerve-wracking inside of Apple right now. So Apple is exploding to new heights. If you go over to the trade tab specifically and start looking, and this is on any trading application, start looking at the implied volatilities, okay, you're going to see something a little bit alarming. The implied volatilities inside of Apple have really picked up. Granted, okay, there is a product launch coming on September 12th. Okay, so the product launch is going to be right in this neighborhood over here. This is an expiration that goes out on September 15th. Okay, we're up to almost a 25% implied volatility. Now, the implied volatility, though, is surprising me, not because it's raising up because of a product launch. It's because the implied volatility is not just isolated to this 13-day option. okay, the implied volatility seems elevated through and through. So I looked at this and I'm like, okay, so it's just a product launch. And I looked back at previous product launches inside of Apple, neither here nor there. Like I didn't see anything that was unusual. This is unusual because the volatility is picked up, okay, through all the expirations. The other thing I noticed is in the IV percentile, it's at the 76th percentile. Now, for those of you that have no idea what that is, again, it's in the 76th percentile. I'm actually going to show you. Okay, we're going to cruise back over to a chart for just a second. And I'm going to come down to a style, load up a style. Look, I've got all kinds of fun style. All this style is an implied volatility chart for 1 year. Okay, what I want to kind of display to you in this particular circumstance is simply the idea. Here's an earnings announcement, increased implied volatility. Here's an earnings announcement, increased implied volatility, increased implied volatility, okay? But you have to recognize where we are right now is beyond most of the earnings announcements in terms of implied volatility, okay? And in the IV, I actually expect it to pick up even more. So as Apple has been rallying, we're seeing, okay, implied volatility picking up quite substantially. And again, if you start to portray this the way that it should be, what the IV ranking means, and we saw that IV rank and it was right around the 76th percentile, it means in the occurrences of implied volatility, the occurrences of implied volatility over the last year, okay, were ranked, okay, up towards the top over there. It's one of the highest instances of implied volatility, okay? That's usually, all right, the way you think of implied volatility, it's a display of a risk. If there is a product that you could probably sell some premium in, it's going to be Apple, okay? There's one other aspect that I want to keep like watch for, and that happens to be the implied volatility, the skew, okay? For those of you that are a little bit more astute in terms of options trading, if Apple rallies anymore, is the implied volatility skew going to flip over? Now, that's something I'll explain a little bit more. For those of you that are kind of Theo traders in our chat room every day, you kind of get what that's talking about. But it has to do, the out-of-the-money puts, okay, typically trade with a higher implied volatility than the out-of-the-money calls. It would not surprise me to see the out-of-the-money calls start to flip over. If Apple starts to rally again, I think the implied vol and the risk is actually going to be to the upside. Think about it here in kind of the days to come. That would be an incredible opportunity to flip over and take a bearish position inside of Apple. And I'm going to be looking for it throughout the course of this coming week if the implied vol skew flips over. Now, again, Apple, as we mentioned, has an increased IV percentile, but I started looking through at other products like Microsoft, okay? So, you know, where's Microsoft? It's almost at the 50th percentile. What I find interesting and a little bit alarming, you have products that have been rallying substantially, but their IVs are staying up there. Okay, so again, I kept looking through product after product after product, and ultimately you find they're still in a relatively elevated stance in terms of implied volatility. All right, so let's switch gears a little bit. Again, it's not just about leadership kind of coming from Apple. It's that Apple, okay, and Facebook over here seem to be the market. That's it. It seemed to be the market. Again, we just had Microsoft kind of reverse in terms of trade on Friday to be watched, again, very, very carefully over here. The financials, any more sell-side activity in the financials will absolutely dampen the spirits of anybody that's long inside of the S&Ps. Okay, as I was saying, switching gears, one last trade idea to throw at you, and this happens to deal with XLU. You know, I was talking about this explosive move, just incredible and explosive move in a really unlikely kind of candidate, and that happens to be specifically in the XLU. It's the utility sector. I mean, the utility sector, not exactly reinventing the world. Looks like it's going to roll over right now. Establish bearish positions when and where you can. What does that ultimately mean? You know, you can come out here to like, 35 days out. Keep it really simple, all right? Just use like an in-out spread, okay? What that amounts to, listen, we're trading just shy, okay, of the 55 level. You might be able to do these 55.50s, and again, maybe these 55.50s, 53.50s for right around $1, okay? Establishing a bearish position with an in-out spread. This is just risk $1 to be able to ultimately make $1. There is a dividend in here, the puts are not impacted by the dividend. So I would not want to sell, okay, the call spread in here. I'd much rather buy the put spread. I don't want to be negatively impacted by the dividend over there. So again, a lot to look forward to kind of in this next shortened trading week. A lot to think about. Again, look to see if there's continuation of the reversal in Microsoft. Look to see if there's any more downtrend whatsoever in the XLF, because I think the XLF right here, this is the forefront of what the S&P's next move ultimately is. Okay, we know that Google and Amazon have not participated that much, and we know that Apple isn't just like in a leadership role. Like, yeah, again, people look at Apple, it's the largest company out there. Start to think at Apple along the lines of something like Tesla. I mean, that's how crazy the move has become. The largest market cap, okay, in the world is having crazy moves right now, like the likes of Tesla. In fact, if you've never looked at this, go open up a 3-year chart on Tesla. A 3-year chart on Tesla. It's up about 27%. Apple is up 61%. So the next time you think that Tesla is some wild child volatile product, well, it is. But you should compare Apple right to it. And Apple, ultimately, okay, is what's driving most of the order flow into the Nasdaq. Thanks, everybody, for joining us here in this holiday weekend. Well, have a great weekend. See everybody on Tuesday in the TheoTrade chat room. Bye-bye.